Welcome everybody to the third video of the series. Today our topic is investing fundamentals and asset classes. We'll be starting off with the definition of investing. Investing is the allocation of capital into assets with the expectation of generating future returns under uncertainty. The thing with investing is that you're never sure that you're going to get the returns you were hoping for. That means no risk is almost no meaningful return in most cases. And higher expected return means higher uncertainty. The thing is, risk is never avoidable, but it's always manageable. There are factors to investing. For example, volatility. There's a fluctuation of price in the markets, and risk, which is potential for permanent loss of capital. That brings us to the concept of revaluation. It is changes in how the market prices an asset. The price can change without fundamentals changing. That is because the markets are all about expectations. It's not about the fundamentals always. Sources of return from an investment. It could be growth, which is increase in value of an asset. It could be income, which could be dividends or interest. Now, dividends are payments made by companies to shareholders from their profits as a reward for investment. Now, you get dividend profit for just holding the stock. You don't have to do anything else. And there is diversification, which is very important. It is combining assets to reduce risk. In other words, don't put all the eggs in one basket. Pretty sure all of you have heard that at least 1,000 times, but yeah, that is important. Now, on to asset classes. We'll start off with stocks. Stocks, as you probably know, is ownership in companies. For example, owning 10 shares of Nvidia. How you get returns from these is, growth, as we've discussed earlier, could be dividends, and could be market expectations. However, there are certain risks to it, of course, which is business failure or market volatility. Moving on to bonds. It is lending capital for interest. Returns are usually fixed payments and interest rates. Moving on to ETFs, the exchange traded funds. They're a collection of assets. For example, S&P 500 is an ETF. The function of these is diversification. You get diversification while getting proper market exposure, and it reduces company-specific risk. Moving on to cash. Cash has the lowest risk nominally out of all the asset classes we discussed, and has the highest liquidity. But it's got one very big limitation, and it is that it loses real value over time due to inflation. And lastly, we have commodities. Now, commodities are your raw materials, basically. Your gold, oil, silver that you can invest in. And they're, of course, influenced by supply and demand, and you get market exposure.